All right, good morning, everybody. So this is the last chapter that we will cover in this class. And as I mentioned about a week ago, what this chapter really looks at are costs and how we deal with costs, how we recognize expenses, how we capitalize certain costs subsequent to acquisition. So the preceding chapter, chapter 10, was all about really at the point of acquisition, how do I record the value of an asset? What items do I debit to the asset account? That is, what items do I capitalize? And what costs would I just expense? And we looked at various exchanges, various considerations paid for at acquisition. So now we're going to move into like what happens after we've acquired assets and the costs that we allocate after that. Now, one of the major costs that will occur with any asset under US GAAP after we've allocated it for any non-current asset, we have to allocate costs, and allocating the cost of fixed assets is just depreciation. And it's depreciation when applied to PP&E. It is called amortization when it's applied to intangibles. It's called depletion when it's applied to natural resources. And so why must we do this? Now, if we think back to chapter 10, when we acquired assets, a lot of the costs were capitalized into the asset account that we acquired. So we debited a building account or debited an equipment account. We did not debit an expense account for a lot of the acquisition costs. There were a few, and there was a few circumstances when we did, but for the most part, we included those into the value of the asset. We capitalized it. Well, because we have actually incurred cost, even though we put it into an asset account first, we do have to recognize the expense of that purchase acquisition over the period of time that we use those assets to generate revenue. And of course, this goes back to the matching principle. It's one of the primary things in accrual accounting that you have to get used to, is the idea of how we match costs, how that impacts when we recognize expenses. For assets that we anticipate long periods of revenue recognition, for non-current assets, PP&E, intangibles, we have what we call a service life. So the service life is the period over which we expect to generate revenues. It's also sometimes referred to as the useful life. So don't get confused by those two being used interchangeably. It just refers to the period of revenue generation in operations. So if I think I'm going to be able to use a piece of equipment for 10 years, then it has a 10-year service life. And that means that I want to allocate its costs through depreciation over the course of those 10 years to match them to those revenues. In our estimation of depreciation, we will sometimes get what we call a salvage or residual value. And the salvage or residual value is just the estimate of the asset's fair value, what we can sell it for. Or maybe another way to think of it is the value that can be recouped. So I might have bought it 10 years ago at $1 million, but at the end of its service life, 10 years, maybe I'll be able to sell it for 100,000, and then I can recoup 10% of my initial expenditure, right? 100,000 of $1 million. So that's just what salvage value is. It's just a prediction, an estimate, and so is the service life. We have an estimation of how long we're going to be able to use this. And so because both of these are estimates, we will sometimes have to revise those estimates over the life of the asset. Maybe we thought we could use it for 10 years, but then in year 8, it becomes evident that we can use it for an additional 2 on top of the 10. So instead of just having year 8, year 9, year 10 remaining, now we have year 8, year 9, year 10, year 11, year 12. And that's fine. It's an easy adjustment once we figure out how to perform the manipulation. And then we just apply the new estimate given our updated belief on the estimate. There is some arbitrariness to the methods of depreciation. You can use straight line, double declining, or declining balances. You can use units of production or input. You can use some of the year's digits. Predominantly, the most prevalent and pervasive depreciation method used by companies in financial reporting is straight line depreciation. So there are a lot of methods, but I think it's somewhere on the order of around 90% of assets are valued, their costs are allocated by straight line depreciation. Now, one thing I really want to drill into your head, because it's something that very much distinguishes someone, in accounting and understanding the world of financial reporting versus a sort of layperson's definition of depreciation. Depreciation is not a value-seeking exercise. So we don't get a fair value after applying depreciation. Applying depreciation does not calculate a fair value. So just because, for example, we have a piece of equipment that we bought for 10 million, or not, yeah, we'll do 10 million. It's a little bit more round. We bought it for $10 million. It has a useful life of 10 years, and we'll just say no salvage, and we're using straight line. Then if we have no salvage, that means that we are going to depreciate every dollar of this amount over the machine's useful life. So then after the first year, the accumulated depreciation with this equipment account would go up to 1 million, because we're going to do, if we're doing straight line, 1 million a year, every year for 10 years. Then the book value of this equipment is, oops, sorry, I put 9 million there. Got ahead of myself. Should just be 1 million, because 0 plus 1 million is 1 million. The book value of this is 9 million. But the book value is not telling me, oh, I could turn around and sell this equipment for 9 million. It's just giving me the book value. It's historical costs minus the total accumulated depreciation at that date, at that balance sheet date. So it does tell me about kind of some indication of the useful life remaining in the firm's assets. So if the book values of PP&E in total are approaching 0, then that means that we've applied all of the depreciation that we think we're going to apply over the useful life of the asset. And that means that if we're at the end of the useful life, remember, useful life means the period of revenue generation. Well, then to some degree, what this number approaching 0 indicates is that my PP&E may now be very close to not generating revenues in the company's operations. That could signal that the company might need to make some additional capital expenditures to buy new equipment. Maybe If they're getting low and approaching zero, they could change estimates and decide that they could use it for a few more years, and so they would divide it up over the remaining life. But still, this gives me some amount of information. What it does not tell me, if it's approaching zero, it does not tell me that this equipment is useless, that there is no fair value, that it has a $0 fair value. So make sure you don't conflate depreciation with fair value. Okay. They're correlated in some ways, they're associated over time, but they are definitely not equivalent terms. If, for example, the asset no longer generated revenue for one business, which means that we're at the end of the useful life, and consequently the book value would be close to zero or zero if there's no salvage. It doesn't imply that another business couldn't use it in their operations and therefore find value. Therefore, they would want to buy it. Now, we do have an estimate of what we think the fair value will be at the end of the machine's useful life. And so, but that's not really a great estimate, because we're making that perhaps 10, 15 years out if we haven't updated it. And so whether or not it actually reaches a fair value that is the residual value of the asset remains to be seen. We have to fact check it, essentially. That you can read through that. I don't really want to get into it. It gets a little too complicated for a pretty simple concept. Basically, that depreciation does not get me to the fair value of the asset, even though if we have a salvage value, then that salvage value should be our best guess of fair value at that point. Remember that that salvage value was created years and years and years ago. And on top of that, in practice, most companies do assign a salvage of zero. To all assets. They don't even bother trying to come up with a fair value estimate. It's basically just a way of simplifying the calculation. The effects of depreciation expense, amortization, depletion. Remember, each of these is just a cost allocation method applied to different classes, categories of assets. Each method results in an estimate of the expense and a credit to the contra account. The two of them, the amortization and depletion, these don't tend to credit a contra account, they credit the asset directly. They don't, for example, credit accumulated amortization or accumulated depletion. Depreciation does have a very commonly known contra account that we put these in, accumulated depreciation. There's no difference in what we're doing when we credit accumulated depreciation versus crediting the asset directly, because in both cases, we reduce assets. We either credit and increase a contra asset, which reduces assets, or we credit the asset directly, i.e. we credit a patent or we credit a coal mine, and that reduces that asset account. And that's just basically the same effect. Don't worry about the cash flow effect so much. You'll talk about that in intermediate 2. Measuring, a lot of this is just defining what we're doing. You don't want to just roll with the simple formula, because if you don't really understand it, it becomes more difficult to apply it. Every asset has an allocation base, And the allocation base is just what the acquisition cost was. So basically what we figured out in chapter 10 versus in subtracting off the salvage value. And the idea is I want to allocate all non-recovered acquisition cost. So if I had a historical cost of 10 million and I decided to actually estimate a salvage, and I was like, I believe that at the end, I'm going to be able to get back 1 million. Then based on this outflow versus inflow at the end of the life, I would be out 9 million. That would be my non-recovered acquisition cost, because presumably if I estimate a salvage of $1 million, that means I'll be able to recover $1 million. We already talked about service life. We already talked about the allocation base up here. Every method of depreciation considers the allocation base. And as I mentioned, because most companies set salvage to 0, the allocation base simply becomes the acquisition cost at the and that we just expense the whole thing over the useful life. So then we get into the common methods, and this is where I take the same example and walk it through a straight line, some of the year's digits, talk about declining balance methods, move into activity-based costing. These are all methods that we tend to cover. I don't know why we cover them in such detail, but since that is the current teaching curriculum for principals, I do have, as I alerted by the announcement, a video that has me walking through these and talking them through, but I don't believe it's the most useful piece of class time for us. And then I also talk about basically with the choice of depreciation method, companies overwhelmingly use straight line. The accelerated methods will recognize more expense in the short run. The accelerated methods are the double declining balance, or the double declining is pretty popular, but you can have like triple declining balance. You can have 1.5 declining balance. So the declining balance method in the sum of the years are the ones that tend to provide an accelerated amount of depreciation. Most of the depreciation expense is recognized in the first year. The straight line, of course, recognizes an even amount of depreciation. This line right here that goes straight across, this is my straight line depreciation. Doesn't come out, of course, in black and white. The two accelerated methods, and this is depreciation expense on the y-axis. Obviously, they have a lot more depreciation expense in the first years, right? Because notice in years 1 and 2, and it's not until year 3 that their depreciation expense crosses over and becomes equal to the straight line. And then in the latter years of the life, they recognize less depreciation expense. So the straight line, same amount throughout. The accelerated tend to recognize a lot at the beginning and then eventually less than straight line. And the activity-based costing, which is the one that kind of bounces around, it just all depends on how active the asset is during that period. The more activity it has, the more depreciation expense is recognized. So in year 1, it was rather active. In year 2, it fell down to almost, to less active. Then it became more active in year 3 than it was in year 1, etc. The reason why accelerated methods start out high and end up lower than straight line is that, again, if the allocation base is constant, if these are all different methods applied to the same amount of money we're trying to expense over 5 years, then say, for example, we have a historical cost of 10 million, right? And we're going to expense it over 5 years. Well, if I do more in the first years, then I'm going to eventually do less, because all I'm going to do in every single one of these scenarios is recognize $10 million of cost and depreciation expense. It's just about whether I want to do it, if it's straight line every year for 5 years at 2 million per year for a $10 million asset over 5 years, or if I want to start out high and recognize a substantial portion of that cost in the first years, well, then I have less of that 10 million remaining in the final years. Overall, if that's looking at depreciation expense, right, the amount of just expense I recognize in any given year, if I look at the accumulated depreciation, how that builds over time, then it's going to build more rapidly for the two accelerated methods. These are the two accelerated methods. Notice they build up accumulated depreciation very quickly, but then it starts tapering off, it diminishes. And this is when their expenses, there's less expense for them to recognize at the end of the useful life. The straight line is the straight, it's always a straight line, no matter how we depict it, is just steadily building that accumulated depreciation. But notice they all reach the same point at the end. They all recognize the same amount of cost over the entire life of the asset. And as a note, you know, when we were studying inventory, I told you that if we choose, you know, something like, for example, LIFO, to report our taxable income, because we like having a significant reduction in our taxable income with LIFO inventory accounting through cost of goods sold, then we have to, absolutely have to, report using LIFO. That is not the case with depreciation methods. And so because of that, what happens typically is companies use accelerated methods for tax purposes. Which provides them with higher expenses in the first years. It saves them taxes faster. And companies use straight line for financial reporting. So they're allowed to have that tax deduction with the rapid tax deduction with the accelerated methods, and they're able to have less of an impact, you know, less of a volatile impact on their income reporting for financial reporting. So they get basically the best of both worlds. I don't worry about group and composite methods of depreciation. I kind of think they're sort of, I mean, there's something that it could be on the CPA exam, but they're if you get basic depreciation and you happen to get a company hired by a company, or you're auditing a company with group composite, it's an easy translation. It's not that hard, but it's a little too much detail for what I want to present to you right now. All right, so yeah, don't worry about that so much. Moving into depletion and amortization. So these two, like I mentioned, are the same idea. We're allocating a cost over time. We're debiting an expense instead of depreciation for natural resources. We debit depletion expense, and we credit the natural resource directly. Like I mentioned, we're not crediting a contra asset. We are just reducing the asset directly. whatever natural resource that might be, whether it's maybe like a mineral deposit, oil, gas, etc. And depletion is, of course, net income, reducing. All of the allocation methods are operating expenses. They would all fall under operating expenses, just so you know. They would be up at the top of the income statement. Then we have amortization. There are two, it brings up a distinction between two types of intangibles. We have what we call indefinite life intangibles and finite life intangibles. Indefinite life intangibles are not as many. Goodwill, trademarks, and certain franchise contracts are what we call indefinite life intangibles. They have no limit on their useful or legal lives. And we do not apply amortization to these. You can kind of lump them in the same category as land. Land is the only PP&E that is not depreciated. These three types of intangibles are not depreciated because they have indefinite lives. They go on forever. They're not bounded with a useful life estimate. When we're talking about finite life intangibles, patents, copyrights, those sort of items, then they are finite life. They have a finite useful life, and therefore we do amortize them over their useful or their legal life, whichever is shorter. So there's a legal life of intangibles. Patents have a certain legal life. I believe it's 20 years. And copyrights have a legal life of whoever the owner of that copyright is, like an author or a musician. It is a number of years past their death that there's a copyright on those intangibles. But the useful life to the organization may be different than the legal life. Like perhaps they have a patented process and the legal life of it is 20 years, but the company assumes that it probably will only be useful for income generation over 10 years. In that case, we take the shorter of those two and apply the useful life because it's 10 years versus the 20-year legal life. And again, we have this case where amortization is debited and we credit the intangible asset directly rather than crediting a contra asset like accumulated amortization. It's just not something we tend to do. We credit patent, we credit copyright, we credit whatever it is that we're applying the amortization to, but not a contra account. All right, so that is a lot of just the kind of concepts, the setup, where this fits in to our overall financial reporting system. And, you know, like I mentioned, I skipped over some more tedious calculations because it's a review. It's not terribly difficult. And you have another video that you can look at if those calculations are getting in your way. But people tend to not really have an issue with the calculation. What people tend to have more issues about is just really understanding what the process of depreciation is attempting to do, you know, what it means. It is not correlated with fair value. And it is simply just a way of us matching the acquisition cost to the years we believe the company will generate revenues from it.